But let's bring on board Kumar Rakesh. He's IT and auto analyst at BNP Paribas, and he's here with us in studio. Kumar, great having you.
Thanks a lot for having me.
Wonderful having you here. But let's start with auto, right? Let's try and understand what trends you're looking at from the auto sector, which were a bit of a surprise from a Q1 FY27 standpoint. What surprised you on the upside, downside? Just give us a sense first. Let's start with that.
Sure. So going into the quarter, we had fair sense that commodity pressure is going to be the key monitorable in this quarter. We have seen every month, actually now every day, we have started tracking the commodity prices. We are tracking about 11 commodities in total. And cumulatively, we track how they are moving because all the commodities are moving not necessarily in one direction. Year to date, we have seen what the commodity inflation is indicating, a pressure of about 7 percentage point hit. We have already seen more than half of that to play out in the first quarter. And that was the kind of headwind these companies are going to look at. But what was going to happen was some of the companies were going to manage it much better, which showed up in the results as well. And these are the two-wheeler companies with heavy exposure to the export markets. And because of that, the currency depreciation came and saved a part of the hit on the commodity side. The heavily domestic exposed companies, which are most of the passenger vehicle companies, were expected to see the brunt of the commodity pressure, which is unfortunately what we saw in the quarter. It was going to be tricky to estimate the margin in this quarter because the moving parts were pretty large. But seems like generally the two-wheeler companies have managed much better and surprised positively on the margin front. Passenger vehicle companies were expected to take the higher hit, but seems like the hit has been higher than what we were expecting going into the quarter. And that generally has been the negative surprise. The saving grace has been that the revenue generally across all the companies have been better. So the mix or the price increases, all of that has partly helped in surprising positively on the revenue side. So generally across the board, revenue surprising positively. Margin for passenger vehicles start below expectation. Two-wheeler companies generally doing better on that front.
So what will bridge the gap between what you're seeing in terms of a demand trend for two-wheelers versus PVs?
So far we are seeing both the segments, at least on year-over-year basis, doing pretty strong. If you recall, late last year in early September, I had come on your show and spoken about that, how the price elasticity is going to kick in once the GST rate comes down. And we were expecting mid-teen sort of a growth inflection for the industry. Two-wheeler and passenger vehicle are, since 15th August of last year, are delivering about 18 to 19% sort of a growth. So we are seeing pretty strong growth across both the segments. Now, the question which most of the investors are dealing with right now, as the base becomes tougher in the second half and we have to look beyond the next couple of months, what happens to passenger vehicle and two-wheeler? Going into the second half, at least how investors are positioned, they expect that two-wheeler should do better and potentially passenger vehicle companies would struggle more.
Why is that?
So that is the investors' expectation. I don't necessarily think that would be the case. But from investors' perspective, they have seen that the two-wheeler companies, even before the GST rate cut, were doing reasonably okay. And hence, there is more model launches, execution is better, and price impact has not been as high because some of the passenger vehicle companies have to take price increases, which two-wheeler companies not necessarily have to because the export is there to offset the commodity pressure. And all of that put together seems like the expectation. Why we partly differ from that is these year-over-year numbers when we are looking at, everything is looking great, 20%, 30% growth. It's really difficult to make sense of it, that what exactly is happening on the ground. So we thought, let's change the game. Let's look at the numbers on quarter basis. Sure, there is seasonality to it. We'll compare that with how the industry has done over the last 20 years in June quarter over March quarter. What we are seeing is this year, we have seen some bit of softening in June quarter, more than what we historically have seen. Actually, June quarter of this year potentially would be the softest for two-wheeler in last 20 years, outside of global financial crisis and COVID period. Passenger vehicle also has softened in June quarter. It makes sense that it should have softened. The commodity prices have increased the price of the vehicles. There is inflationary concern as well. There are other concerns as well on the macroeconomy evolving. And hence, the softening is largely explained. But what we are noticing is that the softening in two-wheeler is higher than the passenger vehicle. And more importantly, as we get into the second half of the financial year, the base for two-wheelers is much tougher than that for passenger vehicle. In the second half of last financial year, two-wheelers had grown by 22% compared to passenger vehicle growing at about 14%. And hence, if you put these two things together, the first quarter is softer for two-wheelers on a sequential basis compared to passenger vehicle relative to history. and the second half base becomes tougher, it implies that the two-wheelers could potentially start underperforming in second half. We are not saying that you pull the trigger today and the trade should go in, but what is making us concerned on this is that the investor seems to be positioned on exactly the same trade across, be it domestic investors or foreign investors, hedge funds or long onlys, long two-wheelers, short PVs, and that seems to, at some stage, could become a crowded
Peaking
trade.
out, yeah.
Yeah, and hence we have to be really mindful getting into second half that are we all positioned on the same side, and there's a risk of disappointment on that, and hence that's something which we'll be tracking very closely.
So since we're building the case for now investing and switching to PVs unfortunately is not one unilateral trend. Each company differs from the other. What are your observations on who stands to gain most, who stands or who's least to gain?
There's two ways to address that. One is what we are arguing here is that there is abundance of bearishness on passenger vehicle stocks. So the stock which had the peak bearishness should reverse the most. That would be Mahindra because of the tractor concerns around that. So we think that potentially benefits the most. So that's one framework which we can use. The second more fundamental framework would be the company which is able to manage margin in this environment better should be the company who benefits most. Again, Mahindra stands out in that because their customer base would not be as price sensitive as that of, say, Maruti or even Hyundai. And hence, as we get into the second half, the base for Mahindra is not as tough as for the rest of the passenger vehicle companies. And then you have the price increase ability to take and pass it on to customers. All of that put together seems like among all the passenger vehicle companies, we think Mahindra could be a better position name.
Kumar, if you look at how PVs have worked, there was a tailwind of entry-level cars which came in after the GST cut coming in. With the price hikes, is that tailwind now tapering off for the PVs?
So the price cut tailwind which you're talking about, post the GST rate cut, we have seen the inflection because of that. We estimate the price elasticity for the industry to be between 1.6 to 2 times. That implies the industry should have seen a growth of about mid-teen, low to mid-teen sort of a number. What we are seeing is a growth of about 19%. So that explains that the remaining 4 to 5% of a growth is just the expansion of the addressable market. What it means is that think of the end customers or at the addressable market as a pyramid based on the household income.
Yeah.
And this price cut, what it did is that the lower end of the pyramid just moved further lower. So your addressable market has expanded. And because of that, you are seeing more growth than just the price elasticity would have explained. And that's what we are seeing in the in the passenger vehicle industry. So we think that the price cuts have helped the industry not just deliver better growth on lower base, but also on structurally improving the growth outlook for the industry because the addressable market has expanded.
And the price hikes now which have come in, will that again push up the base for?
That definitely is a risk as we get into the second half because some of those price cuts have been offset by price increases. I would assume that if the commodity prices start softening, which we saw in June, the moment the MOU was signed, the commodity started softening immediately. If that plays out in the second half, we would see these price cuts in different shapes and forms getting reversed as well. So we are working with our base case assumption that these price increases are more transient and not going to be sticky because these commodity prices we are building an assumption are not going to be sticky and at some stage starts turning off.
And how do you put EVs in this whole game? The adoption of EV as well as the penetration of EV has gone up in Q1 compared to Q4.
Yeah.
How are you placing EV and the growth that EV is going to bring in from a portfolio point of view of various companies?
So let's slice that into PVs and two-wheelers because the EV journey in both the segments are different. In two-wheelers, it's a structural trend, clearly. The customers have understood that the cost of ownership of EV is much lower than ICE vehicles, and hence they are going and buying EVs. Even when the incentives have been coming down in India, the penetration hasn't fallen. It continues to rise up, and that's a clear indication that customers, in the mind of customers, they understand that buying an EV is a good proposition. What they need is access to the network, both the dealership and the service network, and also the vehicle at their price point, which gradually is expanding now. So as and when that keeps on happening with multiple OEMs now talking about capacity expansion, product launches, we think that problem keeps on getting addressed, so this structural story continues. It's a bit different, and in two-wheeler side, it doesn't necessarily need the charging infrastructure because these are smaller battery, can be charged at home, so it's not dependent on the infrastructure coming online. the story on the passenger vehicle would be slightly different because you still need the charging infrastructure. You are taking a longer journey compared to two-wheelers. The battery pack and size would be much bigger, and hence the price difference between an ICE and EV relative to two-wheelers will be higher, and the government incentive is not there. At least the demand incentive is not there. Production incentive, sure, it is there. And finally, we haven't seen most of the OEMs participate into EV in a big way. In the two-wheeler space, we have the startups who came early and disrupted the industry. In the passenger vehicle industry, it's the existing players who have been rolling out the EV launches at their own pace, and different OEMs are launching at different pace. And hence, what it becomes dependent on is when these OEMs launch their product. Sure, that is contingent on the cost parity and all those things, but that becomes the more bigger driver for EV adoption. So whenever you see a new EV launch, the penetration goes up and then plateaus around that level, next launch, and that becomes the key catalyst for it.
I want to ask you a quick follow-up on two-wheelers, because at the premium end, we've seen fantastic demand, right? You expect that part of the demand to hold up, or you expect some dampness there as well?
So what has happened in the premium end is specifically the market leader in that Royal Enfield, right? What they have done is they have expanded their portfolio. Now they are addressing a bigger price point. And that was critical for that segment to do well. Because at some stage, it starts becoming a TAM problem. Because if you're selling vehicles only above 2 lakh price point, then your addressable market are the customers who either already have a car and want a secondary two-wheeler, or somebody who is really well off and is buying this for their kid or something like that. So the addressable market at some stage starts saturating. But when you expand the price point, bring it close to 1,70,000, 80,000, hopefully even below that, then you start addressing a much bigger market. There is a large chunk of customers who are sitting at 150 to 220 cc segment, almost 20% of the market around that, who wants to upgrade, but it's a steep upgrade for them to just upgrade for 150 cc to 350 cc. What has happened over the last year or two, the price point has come closer to the 200 cc bike price point. And as that gap keeps on becoming closer, we think it creates a longer term growth story for the premium segment, where customers from 150 cc, 200 cc are upgrading to maybe 250 cc at some point. We have bikes in that segment as well. And that creates a long term growth story. But for now, what gives us comfort is that the lowering of the price point, market immediately reacted to that. That's a good indication that there is a market for the product. The product is very much relevant for the market. It's just the price point which needs to be solved for, which I think is an easier problem to solve.
And on the CV end, on the CV end, how are you looking at trends there? Because there was obviously some concern around monsoon. You mentioned that. But CV otherwise, prior to this kind of anomaly with regard to the weather, was expected to hold up beautifully. Do you go back to that in terms of the thesis?
So I'll bucket both CV and tractors in that when we are
absolutely, yes,
talking about monsoon here. And I think you have brought in a very important point, which investors actually have been also concerned about, is that what does the monsoon does and how does the monsoon impact in second half? And more importantly, in the next financial hits. Because in the minds of investors, El Nino is not just a one-year phenomena. The impact rolls into next year as well. It's almost a year phenomena that it plays out. And hence, they are not just concerned about how the second half looks like, but what it does to the fiscal 28 number. First, focusing on the commercial vehicle side. At least the heavy commercial vehicle part hadn't seen the kind of benefit of GST rate reduction, what the two-wheelers and passenger vehicles saw, because it's partly a pass-through for the fleet operators, because they anyways are claiming GST credit. And hence, it was not such a big catalyst. So the growth also is relatively lower, sure, strong at 13% since 15th August, but relatively softer than two-wheeler passenger vehicle. As we get into the second half, we'll have to deal with the macroeconomic issues which you're talking about. Plus, we'll also have to track how the government infrastructure spending plays out from here. The subsidy requirement for urea would have expanded. The crude prices also had gone up quite a bit. So we'll have to see how government is able to manage all of that and what it means for the infrastructure spending. And if there is any cut or slowdown on that side, that becomes a headwind for the second half. For the tractor demand, so far it seems like a pretty strong growth here. We are still seeing 30% year-over-year growth. The general expectation of a flattish year this financial year implies that the second half has to fall by 20-30%. That's a very steep expectation or being extremely bearish. And that's one of the reasons why we are positive on Mahindra, because what is being priced into or being penciled in is a very extreme bearish view, which we don't necessarily think would play out. Why? Partly because El Nino is one of the factor, but tractor demand, if you see, is no longer as cyclical as it used to be pre-COVID. And why is that case? Is because the use cases of tractor has significantly expanded in the recent years. It's no longer being used only for the agricultural activity. We are seeing tractor being used for haulage activity, for construction activity as well. And hence, if somebody is buying a tractor today in any town or village, they are seeing that cash flow is not just linked to one activity, which happens only twice a year, but they can generate cash through the year. And hence, it becomes far less cyclical than it used to be. And that's one of the reasons we are relatively comfortable on the tractor cycle. Sure, it will slow down, but not to the extent what is being priced into right now.
So other than M&M, any other overweights?
We like Maruti as well, partly because of the valuation, partly because of the entry segment coming back in, the part which we were talking about, the addressable market has expanded. Who benefits the most from that? It's Maruti Suzuki. And they are the best in able to cater to that segment. We'll also see 8th pay commission coming in next financial year. So there are some of the catalysts which is playing out. And finally, they are also getting into aggressive product launch cycle as well over the next 4 or 5 years. So all of that gives us reasonable comfort where the valuation is standing today and what the catalysts are lined up seems to be a good start.
Okay. On that note, Kumar Rakesh, thank you so much for making the time and joining in. Good speaking with you. We'll take a very quick break, come right back, lots more lined up.